Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me, Sonal Bhutra, and the bear attack on Dalal Street continues. Benchmark indices have taken a sharp turn for the downside, with the Nifty and Sensex down close to about 0.5%. The Midcap index is down 2.5%. And just look at the way the advance decline ratio has collapsed. When we started trade, you had more stocks advancing compared to declining stocks, and now the gap between the two stands at 1:11. If you want to put a ratio to that, and that is telling you the story of the kind of sell-off that we're seeing in the broader market. And I think that there is still an element of China versus India. China is shut, and it reopens tomorrow, but Hang Seng is up 1.5%, while the Indian markets are under pressure now for the 6th day in a row. And, I was just reading that there is this... there's one article which says that expect fireworks on onshore Chinese stock markets when they reopen. Since 30th of September, when the onshore market is closed, there is an ETF which tracks the Chinese markets. That's up 15%, which suggests that the Chinese index will open up with a 15% gain on Tuesday when it reopens.
The ETFs which track the Hang Seng or the Chinese markets, they have been higher in last couple of trading
so
sessions.
So they're saying 15% in the last 1 week since China has been shut.
Yes, that's been the case, and now investors are looking at in every way possible how to take exposure to Chinese markets as well, sitting in India. But for our own markets, of course, we've seen a fall of around 300 points from the highs on the Nifty, 600 points off the highs on the Bank Nifty. It is at the day's low right now. And when we started the trading session, there was an indication maybe there could be a pullback, considering the handover that we got from the US markets and from Asian markets as well. But that's not the case. Big fall across sectors. None of the sectors are in the green right now. There was Nifty ID for a bit, but that has slipped into the red as well. So a lot that is happening, and Nifty has given up all the gains since we have seen since September 11th. And Hormaz also tells me that since September 27 top, only 2 Nifty stocks are in the green now. And looks like the way things are going, that could also turn into red. But of course, these are things that we'll be tracking very closely. For now, it's a good time to discuss market fundamentals. Chirag Mehta, CIO of Quantum AMC, is joining us now to discuss more on that. Chirag, good morning. Thank you so much for joining in. Well, it's been a sudden fall that we've seen from the highs, and this has come in after that 2 days of continuous selling that we saw on Thursday and Friday. What are markets pricing in? Do you think most of those elevated valuations are something that would start coming down, and there is more to go from these levels?
Yeah, thank you, Sonal, for having me. Yes, valuations were clearly on a higher side. There were very few opportunities that were looking attractive from a valuation standpoint. Given that valuations were significantly higher in the mid and small cap space, and also if you look at even in the large cap space, we're incrementally getting expensive, barring a few pockets of opportunity. So overall, I think this is a good, healthy correction that we are seeing in the markets. As valuations become more reasonable, probably that will be a good time to get back into the market. So if you look at our positioning as well, we are sitting on some cash in the portfolio, given that there were less opportunities available, and hence probably this decline bodes well for us from a opportunity standpoint. And we will be looking at valuations wherever pockets. In whatever pockets there is opportunity that arises, we will be buyers into those pockets.
But have you already started buying, Chirag? What is the cash on your books? Have you deployed part of it? If yes, and also weigh in on this entire India versus China rotation out of India into China and China-related names.
Yes, Reema. So in the value fund that we have, we were about 14% odd cash, and in the small cap fund, we were around 16% odd cash. And cash is not a call that we take. It's a residual of our process. So given that, nothing was hitting our buy zones, the resultant of the stocks that were hitting our sell was the cash that we had in the portfolio. From a global investor standpoint, clearly Chinese market were really attractive from a valuation standpoint, but if you look at the differential between the Chinese valuation versus Indian valuations, it was a tale of two markets. Significantly higher Indian valuations versus significantly cheaper by all counts from a Chinese valuation standpoint. So given that, opportunistically, given the stimulus that we saw in China and the valuation that it was available, there was a tactical play at hand which led to many allocate to China in a rush. and hence we have seen that Chinese market zoom up significantly in a short span of time. Given that, I don't think it's a more structural story. Given that there is uncertainty or elements why investors were pulling out of China haven't changed, and this looks more like a tactical play as opposed to more a structural play. So I think India, from a structural standpoint, remains a much better market to be in, provided valuations correct, and we are seeing some correction take place. So if that continues, that would be a good opportunity even for foreign investors to start looking at Indian market more seriously.
So when you're saying the long-term story remains structural and the valuation part is the concern, are there any pockets where you think if there is some more correction, you would look at eyeing those and buying into them? Is there something that is of your liking?
So from a structural standpoint, see plays like power, industrials, etc. still have a lot of runway left. We think, but from a valuation standpoint, there was a need for correction. Everyone's trading very, very expensive. And hence this correction, if it is meaningful, will give us opportunity to be in those pockets. So currently there were some pockets of relatively cheaper or relatively reasonable valuations, but most of the pockets in terms of consumer discretionary to power to industrials, etc., was all trading very, very expensive. But now with this correction, if it lasts for some more time, probably may give us the opportunity to look at those areas as well.
Chirag, what is a meaningful correction, right, in the market? This is a market which is impossible to predict. So even retail investors don't know whether this is it in terms of a correction. Should one be buying today or should one wait out for even lower levels? So when you say that in power industrials, a correction was due, it's a healthy correction, and you're going to look to buy when, perhaps there is a meaningful correction, how would you define it? Would you look at 5-10% lower levels from here on? What's the real advice in terms of go out and buy today?
So we are a bottom-up stock pickers, and we look at each opportunity on a bottom-up basis. And hence, it will be difficult to pinpoint a number on the index because index is very different as opposed to sectors and companies. And from that standpoint, even at the index level, probably, 10-15% correction will be meaningful enough to start getting opportunities in various sectors and companies. Because if index corrects probably by, say, 15%, probably stocks which were expensive and, come under some sort of selling pressure, probably may correct more than that and hence give you those opportunities that you're looking for.
By the way, a mild recovery on the Nifty is just 60 points from the lows after that fall that we've seen. But something like an HUL, the Tata Steel, Titan, M&M, some of these consumption names are leading to that mild recovery that we're seeing on the Nifty. But of course, it's coming after that major fall that we've seen from the highs. Chirag, anything from the banking space? How are you looking at that particular index? Because there's a lot that's happening. We got the Q2 updates that have come by as well. What's your take?
So it's one space that we have liked because valuations are still reasonable in that space. And it's time when, you're seeing some pressure on NIMs, on credit costs, etc. Not really in the banking space, but in the space of MFI, etc. You're seeing some credit costs come in, which may get, spilled over into segments going forward. But having said that, all those banks which have been prudent in their lending have that franchisee to attract deposits. Credit growth has been slowing a bit, but barring those concerns, valuations, given the growth that is probably expected in that sector, still look reasonable. So we have a high allocation in our portfolios to BFSI as a space and private banks in particular. So we like that space from a valuation standpoint and also adjusting to the growth or pressure on NIMs that you would expect going forward. Still, that looks a reasonable place to be in.
Okay, thank you very much for that. Get into a break. On the other side, we'll take the discussion forward and talk about the capex cycle. Is it on the cusp of a revival? Neelkanth Mishra of Axis Capital will join in for some of these questions.
Welcome back. You're still tuned into Trading Hour. It's time to put spotlight on India's capex cycle. According to Axis Capital's latest report, with the revival in housing construction, power generation, and the emergence of new sectors like green hydrogen, defense, robotics, they believe that India's capex engine has restarted and will run for several years. To discuss more on that, we are now joined by Neelkant Mishra, who is the Chief Economist, Axis Bank, and Head of Global Research, Axis Capital. Neelkant, good morning. Thank you so much for joining in today. It's a pleasure to be speaking with you. You know, a lot has been happening in India, and we've been talking about it being India's decade as well. When you say India's capex engine has restarted, what is your expectation of capital formation over years? Which sectors do you think will contribute to this? And how will it contribute to the GDP growth? What are some of the estimates that you've made going ahead?
See, before we project what's going to happen in the next 5 to 7 years, it's important to think about what has happened in the past. And we dug deep into the reasons for the slowdown in capital formation, which we measure as the investment to GDP ratio or the gross fixed capital formation or GFCF GDP ratio. Of the 7% point decline in that ratio between 2012 and 22, from 34% to 27%, we found that 5% points came from the drop in investments of households in real estate. Another 3.5% came from the drop in investment in machinery by the government and the public sector. And then there were some increases like household investment in machinery or government investment in dwellings and structures. Now, the main point is that the driver of the slowdown in machinery investments was primarily investments in energy and in manufacturing, which was primarily linked to real estate. So the drop in investment was in metals, in cement, in other construction materials, in machinery. Now, as we think about the future, it's very important to see that the real estate cycle is turning. I think inventories are now reasonably low. A lot needs to be built. The market has been quite hot in the last 2-3 years, but I think the construction activity is just about starting to accelerate. The power plant addition, again, announcements have happened, but I think now the construction needs to pick up. And it is when this activity picks up that it will start showing up in GDP. If you take a step back, this is not abnormal. When you think about long-term investments or long-term deployment of savings or capital, it is mostly when people invest in houses, when governments build infrastructure, or companies invest in power plants or long duration investments that investment to GDP ratio picks up. And therefore, I think the real estate cycle is a very, very important part of the puzzle. And we think that's turning, and that's very positive for India's capex cycle.
Okay. Neelkant, hi, morning. So that's one way to look at, right? The investment type, whether it's in machinery, household, what led to the decline and what will drive the recovery. Another way to look at, and that's another axis of spending, is corporate, household, and government. So can you give us data on, these three axes of spending, how the investment has declined in the past decade and what the recovery will look like? Because we keep talking about how government capex has picked up.
Yeah, so government capex has picked up. So if you see state plus central government investments, they have been quite strong in the last couple of years. Some of it, from an accounting perspective, is just the off-balance sheet spending of the central government coming onto the balance sheet. But a large part, there has been a significant improvement in our ability to spend on railways and roads and all of that. But we think in the next 4 or 5 years, this percentage, this expend as a percentage of GDP is not likely to expand. The central government has stated this explicitly. The state governments are spending a bit more than they did, but I don't think there is a lot of scope for them to expand here. The growth, in our view, will come primarily. So as we think about 31% of GDP going to 34%, in our view, nearly half and half, so about 1.6 and 1.4 will come from the increase in household spend on dwellings as people's houses get built, and the rest will come from corporate spending on machinery and somewhat on dwellings as well. The corporate spending on dwellings, on machinery, will come primarily from the power sector. So we expect that the spend on power generation capacity will rise quite meaningfully from where we are. So we've been through a 7-8 year downturn. From 2017 onwards, the spend has been quite low, but now quite a bit is needed. I think it is planned. A lot of the funding has been arranged, and now I think the investments will pick up. So in addition, we are seeing that cement companies, in anticipation of the growth in dwelling construction, have started to expand capex. There is also some competition coming in because 2-3 large groups are competing. Most metal companies are thinking of doubling their capacities in the next 5 to 7 years. And so all of this is in anticipation. And this is very consistent with what we have seen in the past, that whenever the real estate cycle is on an upswing, the demand growth for metals and cement tends to be 4 to 5 percentage points a year higher than it is when the real estate market is in a downswing. So the growth tends to be 8-9% a year when the real estate market is doing well, and it is 4 to 5% or lower when the real estate market is not doing well. And so as this turns, it is very encouraging. And you must have seen that India's imports of steel had picked up last year as the domestic demand has been quite strong.
So a lot of ancillary industries will do well because the real estate cycle, of course, is picking up, be it cement, be it steel. Neelkant, a lot has changed on the state level. Of course, it was a lot BJP earlier, but now we've seen the election results for Haryana, be it Jammu and Kashmir. We're talking other parties coming in and taking charge as well. Do you think that is something which could be a big risk for central government or state capex going forward? The ultimate goal would not match in a lot of cases, and that could be something that could impact the outcome?
So it is less party specific, and it is actually change happening at the state level, which I think is responding to some of the ground level changes. So let me spend a minute on this. India is going through a phase of growth where the increase in inequality is almost inevitable. That you will see that capital is in shortage and labor is in surplus. And when something like this happens, inequality goes up because the bargaining power of capital is far better than the bargaining power of labor. Now, we are the only country, only large country, which is going through this phase as we are a fully functional democracy. And you will see political pressures, which are very natural, about addressing some of these inequalities. So what we have seen over the last 4 years, and this has happened across party lines, is that there has been a rise in income transfer schemes. So starting with Andhra Pradesh in 2020, and then Assam, and West Bengal, and then Telangana, then Madhya Pradesh, Maharashtra recently. And if you see both parties, both sides in Jammu, Kashmir and Haryana, in fact, even in Jharkhand, while JMM is offering 1,000 rupees per month to women, BJP's offer is 2,100 rupees per month. So it's across party lines, and I think it reflects the ground realities of how politics needs to be done and what the demands of the people are. The bigger question is, does this crowd out capex? And I think it's a very important question. What we have seen in the state budget compendium this year, and remember that while Jammu, Kashmir, Haryana, to some extent Maharashtra, and also maybe Jharkhand was not part of this, but there were 9 states which had already done this. And despite that, capex as a percentage of full year expenditure was 15.8%. So in the budgets for this year, the states in aggregate are planning to spend 15.8% of their total expenditure on capex. This is the second highest since 2009. Some of this is also aided by the center's offer of interest-free loans for capex. But yeah, this is an area where we need to keep a close watch. As the state's compulsion on a competitive basis, as well as perhaps the needs of the people, requires them to do more of income transfers, and their deficits are capped, so they cannot spend more than 3% of GSDP. Will they be really taking out of capex? At least so far in the budgets this year, which includes a lot of the transfers. Remember that Telangana, MP, Andhra Pradesh, they've all already have it in their budgets. despite that, the capex numbers as a percentage of full year spend weren't really that bad.
Neelkant, we request you to just stay on. We want to come back and talk about markets and what this revival in capex means for individual sectors like industrial, cement, real estate, power, the ones which will drive the recovery. But by the way, for the markets, there has been a recovery. The low today was below 24,800. And now we're back in the green when it comes to the Sensex, and the Nifty is just about breaking into the green. There's been a very sharp pullback in the markets from the day's low, nearly 200 points. The Nifty is now getting closer to 25,000. The Nifty Bank too is now back in the green, up close to about 60 odd points. And spaces where you are seeing that intraday pullback, well, you've got a Bajaj Finance, you've got an IndusInd Bank, some of the Adani Group stocks, Enterprises, Ports, LTI Mindtree. These are some stocks where there has been that sharp intraday pullback. We'll continue talking about the markets and our conversation with Neelkant. Get into a short break. We'll come back with more. Welcome back. We've been in conversation with Neelkant Mishra, and we're talking about his report that India's capex engine has restarted, led by real estate, house construction, power, and new investment areas. And this will run for a few more years. And therefore, the investment to GDP ratio, which fell sharply from 34% in 2012 down to 27% in 2021, will recover. So Neelkant, the recent low in the last decade was 27%. What does that number rise to, in your opinion? And secondly, the narrative that we spoke about, the expectation, what does it mean in terms of individual sectors like power, real estate, industrials? Because many of them are trading at very high valuations. You also spoke about how cement and metals are likely to see higher growth because of the revival in the real estate cycle. So break it down for us sector by sector.
Thanks. So on the base case, if nothing else changes, so there are no other policy interventions, we expect that this ratio will jump back to 34% by 2029 or so. The upside can come from government signing free trade agreements, and we know that there are several such agreements in the offing. There are several other changes, like say, for example, on semiconductors, where I think the investment sizes can be quite major. So as perhaps a new scheme comes up, maybe we could see another round of big investments. And then in which case there could be upside to these numbers. We could also see, if we finally see some significant changes in how urban infrastructure is funded. So for example, if the Finance Commission was to allocate more funds directly to city governments, or some such changes, then we could see upside to these numbers. But on a base case, if we just allow market forces to work with no other policy interventions, we should reach about 34%. Now, the bigger question is, how do we play this in the stock markets? And from that perspective, our call is that the industrial sector, which is likely to be at the front end of the upside in order books, should be the best beneficiary, the biggest beneficiary. What we have seen as the economy has slowed down in the last 4 or 5 months, that the markets have moved towards the defensives. So we've seen the IT sector, staples, pharmaceuticals. So as the flows have kept coming into the markets and the indicators have progressively slowed, so in the last 4 or 5 months, we have seen cement volume growth slow down, power demand slow down, auto sales have been very weak. In our view, this is temporary. This is occurring because of an unintended tightening of fiscal as well as monetary conditions. We are already seeing with the RBI keeping liquidity in surplus, overnight liquidity in surplus for the last 2-3 months, that they are signaling that perhaps that on the quantity of money side, things have tightened too much and perhaps they want to ease now. We are also likely to see, as the year progresses, that government spending will pick up. In the first 5 months of the year, central government capex was down 19% year on year, but the government is keeping its borrowing targets intact. So this is temporary. In our view, this lull or the stagnation that we've seen in some of the industrial stocks is because of some apprehensions that the economy is slowing down for good, which we don't think is going to be the case. And so that would be the biggest beneficiary. We also think that cement as a sector, which currently has seen the volume slow down. The EBITDA per ton is at like a decade low. In our view, as the volume growth picks up, this could be, from a P multiple perspective, also quite attractive. In our view, the financials, in fact, banks in particular, are also among the cheapest sectors. The raw material that they work with, which is money, was in short supply. M3 growth had actually temporarily dipped below 10%. It is now slightly above 10, but clearly with the liquidity conditions easing, with the Fed's easing, allowing the RBI some more room to be more relaxed with its liquidity stance, there should be more of raw material that the banks can work with, and that should be beneficial for the banks as well. For some of the other, and utilities as well, right? So that's a sector where I think if power demand, currently it is weak, and therefore I think that sector has stagnated a bit. But we expect that as the GDP grows, I think power demand will grow as well. We are less on the P multiple side because some of the growth that you see, for example, in real estate is kind of priced in. While housing and real estate in general will do well, so a large part of that growth may be actually already priced into. And so maybe there is a period of time correction. Some of these stocks are trading at very high multiples, but the earnings growth, even for industrials, the premium to the market is at an all-time high. But the growth in EPS is 25 to 30%. So if you just hold on for that for another year, the P multiples start to correct. We also think that some earnings upgrades are possible. So that's how broadly we would like to manifest this in the stock market.
Very comprehensive view of what different sectors and the growth there would look like. Nilkant, we would have loved to chat a lot more, but completely out of time on this discussion today. But thank you so much for joining in today with your take on the capex cycle and the growth drivers going forward as well. Okay, with that, we'll do one thing. We'll slip into a short break, but here's some good news for our viewers. India's business news leader is now click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store. It's right here. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, just wanted to focus on the chemical space because we have been talking about a lot of dumping taking place from China, a lot of dumping generally happening because global chemical prices have fallen down. Now, interestingly, what is happening is a lot of these listed companies and unlisted chemical companies as well, they're going ahead and filing an ADD or anti-dumping duty investigation request with the government. Recently, there have been two of them. First one has been on investigation concerning imports of soda ash, and this is not from China, but from Turkey, Russia, USA, and Iran. And this is filed by a group, which is Alkali Manufacturers Association of India, which is on behalf of DCW India, Nirma, we have GHCL, Tata Chemicals as well. All of them together have filed this application. Now, remember, even Chinese soda ash prices have been languishing due to demand headwinds. There has been capacity additions in China as well. So one is for soda ash. The other one is for para-nitrotoluene imports, which are exported from the European Union. And this has been done by Deepak Nitrite, which has filed the application bill before the designated authority. And stocks in focus on the back of this is Deepak Nitrite and Aarti Industries. Now, an alert for both of them. Of course, the anti-dumping duty investigation takes around 6 months to 1 year before it finally becomes an order. But the important part here is it's not only Chinese dumping that is happening now, it's happening from other parts of the country, of the globe as well. And that is something which is hurting the domestic chemicals industry because of lower prices. And that's the reason we are seeing an increase in these applications, and actually the authority also taking note of it, and they are starting investigation. So if it does actually go about and gets finalized, it would be a positive news for the industry overall. No immediate impact on the stocks, but sentimentally a positive here.
Okay, thank you very much for that. We will slip into a very short break. We'll come back and talk about credit card spending. Now, the latest report from RBI seems to suggest that credit card spending slowed down 13% in the month of August. Now, Nomura believes that this is as lenders are placing greater emphasis on maintaining asset quality. But we are entering into the festive season. So is there going to be a revival in spending? What are the early trends? We'll get chatting about that. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Well, we are just entering the festive season and a lot of us like to shop as well. And this is via credit cards as well. Shifting focus to the credit card industry then, data for the month of August showed that monthly spending growth was moderating and it came at 13% on a YY basis, which compares with around a 19% number in July. This is driven by falling card additions and moderating growth in spend per card. August is the 5th consecutive month when net card addition has been below 10 lakh. To discuss this and more, we are now joined by Ravindra Rai, the MD and CEO of Bob Card Limited. Mr. Rai, good morning. Thank you so much for joining in. Just want to understand the trends that we've seen in September. Of course, we did see the short season, but we are entering the festive season as well. What are the spends looking like right now? Have we seen a better addition in the industry overall as well of cards?
Well, if you ask me, the spends have seen a little bit of a muted, growth over last year. Basically because of how the season has been. Although there was a good rainfall across India and things have been looking good, but as you rightly said initially, the cards spends on cards have been going a little down. Basically because and we also don't see an irrational kind of exuberance when it comes to the spending pattern during this festive season. Although sequentially Q on Q spending has been good, it's been around 10-15%. And also the year-on-year basis might also look good, but we don't see spends going to go through the roof this time. But having said that, if you look at the market, if you see the other card issuers, what they're doing is a lot of offers are coming in. Even we as Bob Card have bought in a lot of offers, hundreds and hundreds of offers that's been bought in to lure the customers. But the customers also have been very clear with the trend that has been going around. What we've also done is pushing the EMI based festive offers. I think we have just pushed it from 36 months to around 48 months. So this also is going to be a lever towards which we can see some spends going up. But as you rightly said, we are not seeing a big spike in spends, but spends will also definitely be there because that's what OND gives for us during the festive season.
So anecdotal evidence suggests that at least September credit card spending should be an uptick of 10 to 15% on a sequential basis, but it's not going to be exuberant. Mr. Rai, can you also talk about why the number of new card issuances has been under pressure? I believe for the last 5 months till August, it's been below that 1 million mark. What explains that?
Well, the data is perfectly right, but you should also see it in light with the regulators, the kind of focus which has been given towards the unsecured lending. So unsecured lending is in focus right now, and rightly so. And I really believe that India is a country where the regulators have been and on top of their game, and with due regards to that. And that is where I think most of the lenders have been very clear. So with the unsecured lending taking focus, the regulators, my partner there, we all are taking a little bit of a cautious approach. But having said that, the growth has gone down basically because the kind of even if you see this time the weightage, they have increased it from 125% to 150%. So all that put together, we are treading it very carefully. Also, the delinquency rates have gone up. If you ask me, we have been treading very carefully, although we have sustained our delinquency rate below 3%. And it's a cautious aggression with which we are going across. So I think this will continue for the coming 2-3 months.
Quickly, if you can tell us, we are a little out of time, Mr. Rai. I wanted to understand if we are seeing higher delinquencies. That has been one of the concerns. Are they improving or the trend continues?
Well, if you ask me, Bob Card per se, we have sustained or below 3%. Luckily, if you say with the trend that is continuing, we are not catching up with the trend when it comes to delinquencies. But yes, we are cautiously treading this road because these are tough times for cards. But also, I look at it as an opportunity. Say, as the adage goes, get in when the market is low and get out when the market is high. The same way I feel if we tread very cautiously with a controlled aggression, I think we are up there. It's not as bad as it sounds, but of course we should be very cautious.
controlled aggression, right? That's the mantra, at least, that you're following, and perhaps many others in the industry. Thank you very much for joining in. Get into a break. We'll come back with more on the market. Stay tuned.
Welcome back. It's time to get your CNBC-TV18 exclusive. Shireen Bhan caught up with Mukhtar Diop, the Managing Director of IFC, to discuss more on their India investment strategy. Listen in.
By talking to you about India, because this is day 5 of your India visit. Take me through the snapshot of the trip so far.
It was an excellent trip so far, and I met with the Minister for Finance to discuss a little bit what IFC is doing. And it was very impressive to see how the priorities set by the federal government were aligned with what we want to do in India. And as a result of it, actually in the last 2 years, we have tripled our commitments in India, and India is the largest portfolio of IFC worldwide. So that just to show for us the importance of India. But what is interesting in our portfolio in India is not only that we are lending with the debt, but we are doing a lot of equity. And equity means that you trust the country, you trust the company, and you trust a long-term engagement with companies in India.
You've, of course, been long-term investors in India, going all the way back to 1958. You talked about tripling your investments in India. What's the outlook over the next few years? In fact, I'm given to understand that the IFC could invest more than the World Bank itself over the next few years.
Actually, we are already investing more than our sister organization, IBRD, the World Bank. It's because the need of the private sector are important, and we are talking about a country who wants to be the 3rd largest economy in the world, and that will be driven by private sector investment. We have a country who wants to be a $5 trillion economy. We have states who want, I just came from UP, and in my meetings with the chief minister, it was clear we want to become a $1 billion trillion economy very quickly. So the private sector will be the driver for this effort and exercise.
But it's a challenging environment. The global environment is going through a significant amount of volatility. Of course, geopolitical tensions and geopolitical pressures adding to the concerns and the challenges. Does that make it harder for the IFC to try and mobilize private capital, private investments? I mean, you had a record year in FY24, $56 billion, up 28% year on year, on track to the $62 billion target?
Yeah, on track, and I think maybe more. And I have a wonderful team, and the team my team in India is doing a great job, and I'm very proud of what they're doing. And I think that we'll be able to reach our target. And in fact, in the last 3 years I've been here, we've been able to double the annual commitment of IFC in 3 years. So we are in a right trajectory, and we will be keeping it and accelerating it.
Speaking of new opportunities, what's interesting is that you're not just looking at climate and infrastructure, you're also looking at creative arts as well. And you've had some meetings with people here in Bollywood. The IFC is potentially looking at investing in that space?
Exactly. When you must be saying IFC and Bollywood. What's
going on there?
What's going on there? There's something. I mean,
what is the script that you're working on?
No, it means that the world is changing, and there are some things which were not part of the world. We're not talking to each other, and I think that it's important that they talk to each other because of job creation, because of social impact, and so forth. And I'm a passionate of art, so I can see the value personally of it. If you think about Bollywood, for instance, if you want to change the social norms in a country and have the development rules that you want to have in terms of gender equality and so forth, movies are extremely popular, powerful. you can write the best report you want, you can say everything you want, but until the father and the mother go with a little girl to the movies and see someone they identify with, and you touch really their feelings, you will not have the change that you want in the behaviors that you expect people to have and the leadership that you expect women to have. So for me, it's not only about financial investment and return. I'll come back to that. But it's also the impact and really now the economics of it. It creates a lot of jobs. We all know that. It's very important for the image of India as well. I grew up. I'm a West African. I'm Senegalese, and you'll be surprised that when I was growing up in Senegal,
you watched Indian movies.
I mean, everybody watches Indian movies, and you will be surprised to see that in my own countries, people who don't speak a word of Hindi, who have never been outside Senegal, were wearing sari and learning the dance of Bollywood dances they were watching on movies. So, and when I was young, there was someone very famous, Albella, an actor.
Okay, Amitabh Bachchan.
No, but before that, even.
Before that, okay.
Yeah, and there were some actors that in popular neighborhood people knew. So what is happening today? You have great producers and great actors and great directors in India, but they are paid to produce something and to have a product, but the intellectual property doesn't remain with them, because they're financed by a corporation to produce a movie or a series. So in fact, they don't capture the whole value linked to their creativity. So what we would like to do, and the corporation we would like to have with them, is to invest so that they can produce on their own without having financing, sell to these large streaming corporation, and keep the IP. That would be the game changer.
Okay, with that, it's a wrap on this edition of Trading Hour. But stay tuned. Halftime report comes up next with all the market action.